answering your pension questions on why your portfolio is performing so poorly. And I've got the answer from the horse's mouth. You've got to look at this from today's Financial Times. Nick Train apologises for poor investment performance. UK fund manager blames lack of exposure to tech and fossil fuel stocks, as well as broader malaise in the UK market. So what he said is, I perform poorly because I'm not allowed to invest in US tech companies, and British ones just don't go up as much. Well, rocket science wouldn't have been needed to tell you that, mate. And the other reason is that the companies that he could invest in, well, they're pretty poor because he can only invest in UK companies. So I'm glad he's recognised that his own fund is poorly performing, and it's Finsbury Growth and Income Trust, which returned 2.7% in 6 months to end of March, compared with the FTSE All Share, which was 6.9%. And in any event, over the past 3 years, its share price has dropped 2.8%, whilst its benchmark index has risen 23%, which in 3 years is pretty poor, given that the Nasdaq was up 55% last year. So he's the one making comparison to US markets. He's the one making comparison to the big tech companies and saying, well, I can't have them, that's why I'm performing poorly. So for all of those people who are basically apologists for poor pension fund performance, saying, well, you've got to compare apples with apples, it's not fair to compare a UK fund manager with the US markets, which they don't invest in, they do it themselves to explain why they're performing poorly and why they're rubbish. They say, we're not invested in the US, we're not invested in tech, that's where the growth is, that's where the money is, so I'm really sorry that I'm performing poorly. They say it, but of course the apologists will say, yeah, well, you obviously didn't want US tech, why would you want that? Well, because it bloody goes up. It's where the returns are. Nvidia's up, what, 100% already this year? Whilst I got in January 2023, you can see my telegram for that. I did exit in April, probably prematurely, but it was just such a heavy part of my portfolio alongside Microsoft and 2x leveraged Microsoft exchange traded funds and having Apple, Amazon, Alphabet and double leverage on the, it was just getting overweight in those to such an extent. And by overweight, I mean this, not me. I mean that even a small move down was causing a significant movement in absolute money terms in my son's junior ISA, my wife's SIP, and my holdings as well. So I thought, you know what, I need to clear out some stuff. Anyway, it's the fund managers themselves who admit why they're performing poorly, and right from the horse's mouth. We can still make excuses for them if we wish, and St. James's Place will continue selling you funds which will not be able to perform well, and will keep telling you, well, you've got to compare, or your IFA will as well, you've got to compare apples with apples. Well, the fund managers don't, and they apologise for not getting you into oranges and keeping you in apples. You know there is a solution to this. Buy some bloody oranges. Anyway.